Hi, this is Matthew Cratter from Trader University, and today I want to talk about inflation, deflation, and gold prices. If you're interested in learning how the economy actually works and want to learn how to make money in any environment, be sure to hit that subscribe button. So I've been getting a lot of questions about inflation, deflation, gold, Bitcoin, etc. So I wanted to address that. I still owe you guys a more extended video on the CPI index, which we're going to touch very briefly in this video as well. But what I want to say is that obviously the U.S. over the last few months and the whole world, in fact, has been experiencing a huge deflationary shock. This is what happens when incomes go way down, when people lose their jobs completely, when asset prices fall, when stock prices fall, real estate prices fall, etc. So COVID has obviously been deflationary. When the world's economy grinds to a halt, it's been deflationary. And we've seen this in many different sectors, with the obvious exceptions of perhaps certain kinds of medical equipment, ventilators, toilet paper, hand sanitizers. There's obviously pockets of inflation in the economy, but in general, as you would expect, energy prices are still significantly lower, even though they've recovered somewhat. You have energy prices, gas prices hitting a record low over Memorial Day. You obviously have just unlimited travel discounts. You can fly anywhere you want in the world for a very, very low price, free overnights at some hotels. You can get a really good deal on a car. You can probably get a really good deal on a house in certain parts of the world, etc. So as we would expect, the CPI, Consumer Price Index, has been falling since February, since COVID really hit. And there are problems with the CPI index, but I think we can agree that there has been a huge deflationary shock to the system. Now, the government and central banks' response has been inflationary. There have been huge fiscal programs that have been passed by Congress. There's been a lot of money printed by the Federal Reserve, the U.S. Central Bank. But I want to address in particular in this video how gold performs in both inflationary and deflationary environments. And to use, I think my prime example will be the deflationary case par excellence in modern history, which is what happened in Japan when their stock market and real estate bubbles bursted in late 1989, early 1990. This is a chart of the Nikkei 225, which is the Japanese stock market, the main index. And you can see that we've really never recovered to those late 1980s prices. This has been very profoundly deflationary for Japan ever since then. If we look at consumer price inflation, this is annualized consumer price inflation, so essentially their version of the CPI. And we can see it was fairly normal even in the early 90s, right as the bubble was bursting. It was above 3%, but it spent much of the 2000s, the early 2000s, actually in negative territory. So we can see right here, this is, I don't know if you can read this, but this is the 3% level. This is 0. And so if you have negative CPI prices, negative consumer price growth, whatever you think of these indices, there was something profoundly deflationary going on. And it spent much of the time from 2000 to really 2012 or so, when we got Abenomics, in negative territory with brief spikes and brief crashes. This is the great financial crisis here. So this was, we can very clearly say that from 2000 until 2010, certainly 2012, was a very deflationary time in Japan. This may be understating, overstating it. So how would you expect gold to perform in a deflationary environment? I often hear this, that we've had a lot of deflation in the U.S., and so gold is not going to do well. But let's look at how gold performed in Japan over the decade from 2000 to 2010. And in order to do this, we need to look at gold prices in yen. So gold is normally quoted in dollar prices, but if you live in a certain country, what really matters is how gold is performing, underperforming, outperforming versus your local currency. So here's the performance of gold priced in yen from 2000. Early 2000, it was priced under 30,000. This must be 30,000 yen per ounce. I'm not sure exactly the metrics on this, but it went from 30,000 all the way up to right before the great financial crisis, it went up to 100,000. So you had more than a tripling of gold prices. If we scroll out, we can see that the price of gold in Japanese yen has been basically a one-way trip. And since the middle of 2019, going into 2020, in the first quarter of 2020, it's begun to really take off. So here's the most deflationary country in the world. They have they have aging demographics. They have this bursting of the bubble in the late 80s that they've never really recovered from. And it has been the country with the most deflation, at least that I can think of. Nevertheless, gold has gone up. This shows you that you don't need CPI inflation, you don't need consumer price inflation to get gold going up. Now, why do I think gold has gone up in yen terms? Well, I think that the solution is very simple. I never hear economists say this, but they've been printing money. They've increased the money supply. This is a chart of M2, which is one measurement of money supply. Since the late 1980s, they kept the money supply fairly flat in the 90s, which really sort of contributed to the stagnation. Not that I'm in favor of money printing, but then they've basically been printing money every year since then. Unfortunately, this only goes up. The Federal Reserve only has this information on Japan up to 2016. But money supplies for countries always rise in modern times. The money supply fell in the U.S. during the Great Depression, but I think we can generalize and say the money supplies always go up. The central banks are always creating more money, printing more money. So this would be an example of the money supply going up, and as a result, because you have more pieces of money, more pieces of paper or digital money, each one's purchasing power goes up. And so the price of gold in that local currency also has to go up. And that's what gold is, a very nice barometer, because it's very limited in supply. Its supply increases very slowly. We can say that it has a high stock to flow. It's very hard to add to the gold supply. The only thing that's going to have a higher stock to flow than gold very soon is Bitcoin, which we'll talk about at the end. But basically, when you print more money, when you increase the money supply, the price of gold should go up in your local currency. And the faster you increase the money supply, the faster it should go up. So we can look at Turkey. This is the inflation rate, basically the equivalent of the CPI in Turkey since 2015, 2016. And just to give you an idea of the metrics here, this is the 10% inflation rate. These are very high inflation rates, as we often get in developing countries. And so we've spent quite a bit of time above 10% with spikes in the mid to high 20s. This is just unbelievable inflation. Imagine having to a car at the beginning of the year cost $10,000 or 10,000 Turkish lira, and then by the end of the year it costs 12,000 or 13,000. These kind of inflation rates are very, very difficult to deal with, as we would expect. So the currency in Turkey is called the Turkish lira, often abbreviated TRY or TL. The price of gold in Turkish lira has really just gone up over time, and you can see that the slope has been especially steep as the inflation rates have been high. It's been volatile but steep. And so obviously, if you're a local in Turkey, you're much better off storing your wealth in gold rather than in the local currency. And this is what we mean by gold as a store of value. Now, Dan Tapiero had a very interesting tweet this morning, basically showing gold returns in different currencies. Now, if you lived in India, South Africa, China, and Turkey over the last 50 years, there's not a single decade you lost money being long gold. This just demonstrates how much gold is a store of value. And I'll show you a larger version of this chart. Now, so basically on the left here, we have the various currencies, and then we have their return in gold if you are holding gold during that decade. Now, the 1970s are known for being quite inflationary all around the world. I would suggest that the main reason these returns on gold were so high in the 70s was simply because gold had been pegged unnaturally low to the dollar. And when we had the Nixon shock in 1971, when Nixon basically said, you can no longer bring me a dollar bill or bring the U.S. Treasury a dollar bill and get gold in exchange, they basically closed the gold window, as they say, or they stopped the convertibility of the U.S. dollar into gold, and basically this was the beginning really of the modern fiat era, where you had all these currencies basically trading against each other, but there was a temporary adjustment in gold there, a massive devaluation of the dollar, even though Nixon denied it, and that's why gold had such high returns in all of these different currencies, because basically everyone was pegged to the U.S. dollar after Bretton Woods, and the U.S. dollar was pegged to gold. So when you release that peg, you get giant movements in all the developed nations, even Switzerland, and then certainly in more developing nations like Brazil, Argentina, etc. You got even bigger rallies. And then the gold obviously didn't perform quite as well in the decade of the 80s. And then gold really reached sort of its local minima in around 2000, when central banks like Tony Blair and the Bank of England were dumping gold, etc. But the main point of this chart basically is to show that how well gold has done over all these different regimes. And if I can scroll back in, we'll go to the next chart. Shows basically gold performance. This is really over the last 15 years. These are annual numbers. So there are, you do get years where gold can go down 20, 30%, as it did in 2013. But if we look at average returns, they look remarkably like what we hear the S&P is supposed to return every year. So for the last 15 years, gold has returned about 10% in U.S. dollars. If you look across all these different currencies, so the Canadian dollar, Australian dollar, Swiss franc, Chinese yuan, Indian rupee, euro, the pound sterling, we basically got low double digit, so 10, basically 9 to 13% returns in gold. So this is an amazing, if you think about it, this is an amazing asset actually, and much less volatile than stocks. If you think of the crashes we've had in stocks over these periods. And so basically this shows how gold functions as a store of value in a modern fiat money system. All of these countries printing money over this time, increasing the money supply, and the price of gold going up. Now, what is happening in the U.S.? We can see this is a chart of the CPI index over the longer period of time. Obviously, the inflation level, CPI index inflation, was much higher in the 70s and 80s. It's been fairly low since then. And as we saw at the beginning, we've had deflationary effects in the U.S. Due to COVID, etc., at least as measured in the CPI. But the money supply has continued to go up over this whole time. And so it almost doesn't matter whether you have high CPI, low CPI, whether the government's fudging the statistics. The reliable thermometer in the room is the price of gold. It's the price of California coastal real estate. It's the price of rare comic books or rare cars. It's anything that is scarce and that will thus adjust to increases in the money supply. And this is one reason central banks don't like Bitcoin, because it basically shines the light on what they're doing. If we look at the last year of the M2 money stock in the US, is the money supply, one measurement of it, we can see how much it has spiked in the first 4 or 5 months of 2020 in response to the virus. The Fed, the central bank in the US, has been printing money, buying treasuries, buying munis, even buying junk bonds, trying to prop up asset prices. And so we've been, like Japan, we've been in a very deflationary period here for the last 5 months, where we've actually, even the government admits that the CPI index is falling. It'd be hard for them not to admit it. And so what has gold done? Well, gold has done remarkably well, especially over the last 5 months. It's basically gone vertical, really since the middle of 2019. And this is in response to the Fed having to restart QE in the third quarter of 2019 and basically having to ramp up the money supply. So this is the environment. This is why I'm so bullish on gold stocks, on physical gold, and especially on Bitcoin. Bitcoin is going to have the highest stock to flow it's going to be approximately as rare as gold during this cycle as measured by stock to flow. Then it's going to actually exceed it. And so I'm expecting Bitcoin to be above 100,000 probably by the summer of 2021. I think it will start hitting new highs later this year. We'll start trading above 20,000. Certainly by the end of the year, as we experience an increase in the money supply. And so the only way that stocks can keep going up, the only way that Congress can continue to spend money is if the Federal Reserve keeps buying treasuries, keeps printing money, buying treasuries, and monetizing the U.S. debt. So I think gold is one of these interesting things. People try to distract you by talking about inflation and deflation. But there have been a lot of central banks around the world that have stopped buying U.S. treasuries, stopped using the U.S. dollar or U.S. treasuries as a reserve asset. In particular, I can think of Russia and China that stopped their net accumulation of treasuries, in fact, many years ago, and have been buying gold. So the smarter central banks have been buying gold. I don't think the U.S. Federal Reserve has been buying gold, but we obviously have quite a bit in Fort Knox. But this is the background here. This is the this sort of environment where scarce assets like Bitcoin and gold will do very well. So I hope that makes sense. Next time you hear someone trying to pretend that gold's not going to do well in a deflationary time, just show them this chart of gold in yen, the most deflationary country in the world, and gold has continued to go up and up and up. Hope that all made sense. Hit that subscribe and like button if you found this useful, and let me know your questions and comments in the comment section below. Thanks a lot for listening, and I'll see you in the next video.